Okay, everyone, thank you so much for joining us. If you guys are new here, we are AI Capital Partners. There are four of us here. Just a little introduction on us. Collectively, all four of us, we have been in the real estate realm for over 10 years. We have done over 25 million in real estate transactions during that time. And we currently have 17.8 million assets. That's 206 stores under management in Dallas, Texas. So we look forward to being able to provide you guys some education and value. And we would love to start 1,000 families on their journey to wealth through real estate. So the fabulous speaker that we have right now, he is from Directed IRA. His name is Nate Hare. So a little bit about Nate is he has 10 years of experience in finance, spanning from real estate to lending to business development. And he has the IRA expertise. He does hold the CISP title, and that pretty much lets you know that he is an IRA expert. He has been recognized by top 100 magazines, and he's just a wealth of knowledge. So we're really excited to have him. And thank you so much, Nate, for being here. I'll let you go ahead and take it away.
Yeah, and thanks for having me, guys. And I missed that. I wanted to tell people it's 20 years of experience in finance, 10 years in IRA, self-directed IRA specifically. So I've been around the block. That's probably dating me and showing my age, but not quite as young as I actually look. So I thank you guys for having us on. I will tell you, I'm real passionate about what I'm talking about today because I'm not really selling anybody anything. But when I learned about self-directed IRAs and how they really work in 2012, I became passionate about it because I thought, well, why am I just learning about this? And how come everybody doesn't know they can do this with a retirement account? And I just dove in head first and really have found that self-directed IRAs for many people have provided more confidence in retirement, especially when you're able to invest in things like real estate instead of stocks. I'm not opposed to stocks, but there's so many different benefits that come with investing in alternative assets, real estate being one of them. And the truth of the matter is the rich and the wealthy have been using self-directed IRAs for decades. It's just now becoming popular with the masses because there's more access to information and education online nowadays. So it's definitely not a new topic, but it might be new to some of you who are watching this. So do you guys want me to just go ahead and share my screen and jump into it?
Yeah, definitely.
All right. Okay. Well, let me make sure you guys can see my screen there. Can you see my slide?
Not yet, but it's loading. Now we can.
Okay. Well, awesome. So I'm going to keep it really basic for anybody that's watching. And I know I heard some comments that some people have, kind of have an idea of self-directed IRAs and they want to maybe fill in the blanks. That's great. I've got some information for you guys, but I want to just kind of start real basic and talk about kind of what you can own in a retirement account and why it's important to talk about it. At least know what your investment options are and what really a self-directed IRA is and what you're allowed to own in a retirement account. Why would you want to own real estate in a retirement account? What are the tax benefits? What types of IRAs or old employer plans can you use to invest in alternatives? And you'll find that there's really no limit as to what you're allowed to invest in. But when it comes to your retirement account, you just have to pick. If I want to invest in real estate, I have to use certain companies that will let me do it. Most people don't even realize they can invest their retirement accounts in real estate and other alternatives because when you've got an IRA or a 401k at Fidelity or Charles Schwab, they're never going to suggest to you that you can do this because they don't sell those investments. So we're talking a little bit about the differences between traditional investments with Fidelity and alternative investments with a company like Directed IRA. What role you play in when you self-direct your account. And I've got some case studies on how clients actually use them today. We've got about 20,000 active investor clients all across the country that are using self-directed IRAs to invest in alternative investments. So let's just jump into it and talk about first, directed IRA. Who are we? We're a licensed custodian out of the state of Arizona. All that really means is that we are licensed to manage and hold IRA assets. The thing that we're different on is we don't sell investments to our clients. That's where the self-directed and self-directed IRA comes from. So just a disclaimer, I'm not here to sell you any investments. I'm just here to give you education about how you can use your retirement account to invest in alternative assets. Even though I'm an investor myself, this is just for education purposes only. You kind of went through that, so I'm not going to bore you guys with more about me because it's really about the content. And let's just talk real brief about just retirement accounts today, a little state of the union. So the important thing to think when you think about retirement accounts is A, it's the largest bucket of money for the average American. Most people have their money, their life savings built in their retirement account, not in their bank account. Roughly today, there's about $35 trillion in retirement accounts as a whole. That's trillion, not billion, trillion with the T. Tons of money in retirement accounts. And retirement accounts consist of many different accounts. You got your 401ks, IRAs, 403bs, TRS plans, TSP plans, 457 plans. There's all sorts of different plans out there. And usually when people have or start a retirement account, it's with a company that provides them one of those 401ks or 403bs or TRS plans. A lot of you might have those plans right now. When you're employed at those companies, what they usually do is they offer you, a way that you can contribute to that 401k. They might match, which is great because that's free money from your employer. Nothing wrong with that. But when it comes to the investment options, that's where people kind of stop because with your traditional 401k at an employer, you're not picking the investments. You might be able to pick some mutual funds or kind of tell, your Fidelities or whoever's managing that plan, what you'd like to see in your investment. But at the end of the day, you're not in control of what the investments do. Not calling it bad. It's just the way that most of Americans are taught, including myself, how to retire is that you just work at a company, put 10% away in your 401k, and voila, you've got money to retire on once you retire. I will tell you that when you look at the numbers don't really match that sentiment. And what I mean by that is if you look at the average retirement plan, 401k, for example, when a person retires, most people don't have enough money in their 401k to retire. So what does that mean? Most Americans have to work longer, right? You've got to work longer to try to save more money. The problem with that is most people, at least the ones that I talk to, find that their yields on their traditional 401k plans are just not building enough to retire on. The problem that we face today is actually kind of unique is that the cost of living has gone up considerably. So what used to work for a lot of Americans is they can save their way to retirement. They could shovel more money in their retirement account, and that was their way to retire. Well, nowadays, with the cost of living increased, more people are left with less savings. So what's that mean for retirement accounts? You have less money to put in yourself. So it's even more important today, if you want to retire, to find a way to grow the money in your retirement account and not work harder to put more money in from your back pocket. It's important to find investments that have different types of income streams, and real estate's one of them. Real estate versus a stock, let's just talk a little bit about that, on how that's a little different, is there's a lot of different tangible effects that you get with owning real estate as an alternative asset versus just a stock. There's all sorts of things you can own a retirement account, like a stock, but that's a traditional investment. Now, here's the fundamental difference between a stock and a piece of real estate, in my mind. A stock is an investment into a publicly traded company. And if that company goes belly up or bankrupt or decreases in value, there's no collateral to that type of investment. Okay. And it's really one income stream. Mostly, if you're not getting dividends, you're hoping you buy the stock at this price and you're hoping it raises to this price. And if it doesn't, you have no income in your retirement. But when you think of real estate's a completely different animal. For one, real estate's tangible, meaning when I own real estate in most cases, my real estate doesn't disappear. It might go up and down in value, but I'm never left with nothing because it's a tangible piece of real estate tied to a piece of land, which at the end of the day, you can burn the house down, but you still got 50% of the value of the land. Now, most people who buy real estate have insurance on the property because insurance companies will insure tangible assets. So at the end of the day, I think that tangibility on your retirement investments is an important thing to talk about versus just a bunch of stocks that if they go down in value, there's nothing left. The other thing with real estate is there's multiple income streams with real estate. And I think this is where people really find a net effect when it comes to their retirement account is that when you deal with people that are investing in real estate, you've got multiple streams of income. And what I mean by that is you've got the house could appreciate over time and usually does, or the property that you invest in usually goes up in value. Again, it has its dips and valleys, just like the stock market. But at the end of the day, take any period and real estate's worth more now than it was 15 years ago. We really felt the effects of that in the last couple of years. But even if your real estate doesn't go up in value, what usually happens if you own it as an investment is you have rental income. You've got other sources of income that are generated from real estate that you don't get with buying a stock. Now, why that's important to talk about with a retirement account is that retirement accounts don't pay taxes like we do as an individual. So there's some magic that happens when you invest in things that have multiple income streams that are tangible. They're not going anywhere. And even if the property value or the investment value doesn't go up, if it's rented, that's a consistent stream of income. And when you think about what we've all been told, 95% of America's millionaires are built through real estate, but 98% of retirement accounts are invested in the stock market. Just think about that for a second. You would think those lines would cross somewhere. 95% of Americans make their millions in real estate, but more people invest their retirement in stocks. I find that a lot of real estate investors don't even know they can invest in real estate with self-directed IRA. When I ask them, why are you invested in stocks if your experience level is real estate? Because they didn't know. They just didn't know that they can use an IRA to invest in things like rentals, fix and flips, commercial property, multifamily, private equity, private stocks, syndications, notes secured by real estate, and a lot more. The IRS actually doesn't tell us what we're allowed to invest in. If you read the tax code, the IRS just says we don't like two investments: life insurance contracts and collectibles. Those are the only two things that your IRA is not, or your 401k is not allowed to own. If you want to own anything else outside of the ones you see on the left there, you just have to use a company like Directed IRA. And how we work is you have an IRA just like an IRA at Fidelity. Those IRAs are not any different. The only thing that's different is what we allow you to do with it. You tell us what you want to invest in, and we help you buy that investment in the name of your retirement account. And we'll hold the documents showing that you have evidence of that investment. And I'll talk a little bit about that when we get to the case studies, but realistically, there's so many things you can invest in. Most people just don't know because they have to tune into a program like this to find it out. So I'm happy to share this with you guys. So, wrong way, sorry. Go. So what are the types of plans that you can use to self-direct? A lot of people have heard traditional Roths can be self-directed, but there's actually a lot of plans that can be self-directed. And when you look at the plans here on the page, you probably thinking to yourself, well, I have one of those plans. I didn't know that I can use it to buy real estate. Yes, you can use it to buy real estate and all sorts of things. And these are the types of plans that we have specifically here at Directed IRA. I'll cover these plans just a little bit and talk about the tax advantages. But when you look at this page, what you want to be thinking to yourself ultimately is you want every plan you qualify for. The reason why you want every plan you qualify for, and not just one, is because all of these plans, every single one of them is not a person. They're not a taxpayer. They're a tax exempt trust. Okay. They all work in this fashion. You put money in from your earnings into one of these plans. Sometimes you get a tax deduction, sometimes you don't. And I'll talk a little bit about that. But once you put money into that plan as a contribution, that plan is tax exempt, meaning as you buy and sell investments, the IRS can't tax you. This is the way that they've put in place for us to help save for retirement by saying, hey, if you put some money into this traditional IRA or this 401k, we're not going to tax you on the investments until you take money out as a distribution in retirement. So when you think about that, if you're buying and selling real estate in your name, remember, you got to pay taxes every single year. So Americans have a hard time just investing personal funds and getting to retirement because you got to share 30 or 40% of your profit to Uncle Sam every single year because you're a tax-paying individual. I'm a tax-paying individual. My money grows slow because I'm a taxpayer. Money in a retirement account grows faster. It's not a taxpayer. It's not even a taxpayer when you take a distribution out. That's tax to you. But as you invest your retirement account, you can buy and sell a piece of real estate and make $100,000. And guess how much you get to reinvest? $100,000 plus all the principal. So you can see how your growth in a retirement account can really hockey stick, meaning it just accelerates in value because you get to reinvest all the money you made on your previous deal. And that's not what you get to do outside of an IRA. Now, I'm a firm believer you should do both. You should invest in real estate outside of an IRA. But if you're not utilizing an IRA to hold some of your investments, you're just spinning your wheels trying to keep up with Uncle Sam taxing you every single year. So this is why it's so important to talk about these types of plans. There's different categories of plans that you could self-direct. I break it up into personal plans, employer plans, and specialty plans. The personal plans are just your individual IRAs. Those consist of your traditional IRA and your Roth IRA. And again, self-directed is just a marketing term. These traditional IRAs and Roth IRAs here work no differently than the ones at Fidelity. You can just invest in different things with a traditional Roth here. Most people are familiar with how these work, but if you're not, when you put money into a traditional IRA, you usually get a tax deduction on the way in. So let's just say I throw $5,000 as a contribution into my traditional, I get to reduce my annual income by that same $5,000. So I get a tax break at the beginning, but I pay the tax when I take the money out as a distribution. Now, I will tell you, most wealth advisors or CPAs will tell you you should put money in a traditional IRA and get the tax deduction because you're in a higher tax bracket when you work, and then you want to take the money out in your retirement years if you want to pay at a lower tax bracket. That used to work when we could save our way to retirement. If you've got more money in a retirement account that's by the money you put in, then that's a great strategy. But again, it's hard to put money in with less savings these days. I think a better way, if you really understand how the Roth IRA works, and there's a lot of fanatics about the Roth IRA, the Roth IRA can really create generational wealth if you understand how to use it and you start applying real estate as an investment strategy. Because here's how the Roth works, which is different than the traditional. When you put money in as a contribution to a Roth, you don't get the tax deduction. Okay. But I don't want the tax deduction because here's how my mindset is with retirement accounts. I just want to put a small amount in as a contribution. What I really want is I want my investments to grow much faster than what I'm putting in. Because if I want to put money in, I got to work more hours. If I want to save for retirement and not have to work more hours, I want my investments to have larger growth. So again, like I mentioned with real estate, multiple income streams and appreciation. So if my growth far exceeds what I put in, I don't want the deductions on the small amount. I want the tax-free growth on the larger amount, right? So I've got clients that have turned 60, I'll give you an example, and just off the top of my head, a $70,000 Roth IRA into $4 million through real estate. Now, if you let a CPA talk you into a traditional IRA, what you really are doing is you're taking a tax deduction on 70 and paying taxes on 4 million. That's a huge tax burden. You just don't see it until you start taking distributions. So it really, I'm not saying one's better than the other, but if you're going to invest and have the growth, if you're going to take a small bucket of money and make it larger, well, you don't want to pay taxes on the larger bucket. You want to pay taxes on the smaller bucket, regardless of whatever tax bracket you're in today or in retirement. Other thing with a Roth IRA that's really cool is when you get to retirement, distributions work a little different out of a Roth IRA. Distributions, once you hit age 59 and a half, and you've had a Roth IRA for 5 years, to give you an example, all the distributions you take from your Roth IRA at that point are tax-free and penalty-free for the rest of your life. Okay. I've got a client that owns 12 rental properties in a Roth IRA through us. This is how he retires. Those 12 rental properties are not owned by him, they're owned by his tax-free Roth IRA. He's had the Roth IRA for 5 years. So every time a renter of those rental properties pays rent, that rent goes to his Roth IRA as the owner. He takes a tax-free, penalty-free distribution out of his Roth every single month for about $15,000 and pays the IRS nothing, nada, zero. The IRS doesn't get a piece of that. If he owned that in a traditional IRA, he's got to pay taxes on every single distribution. Okay? The interesting thing is his account balance goes up every year, even though he's taking $15,000 out of it every single month. Why? Because he's only taking out the rents. The real estate values are going up through appreciation, so that's driving his investment values up. But here's the beautiful thing about the Roth. Not only does he not have to pay taxes on any money he takes out to himself, is when he passes away, That Roth IRA doesn't disappear. It just turns into what's called an inherited Roth IRA. And inherited Roth IRAs go to your kids or your grandkids or whoever you designate as your beneficiary. And those assets just turn over to them. And guess what they get to do with their inherited Roth IRA? Take tax-free distributions of that income for at least another 10 years. So Roth IRAs, if you think about it, if you plan it out right, not only create tax-free income for you in retirement, but create 10 years of tax-free income to your future generations. And that's really how the rich and the wealthy have been playing this game for many years. But if you listen to most wealth advisors, CPAs, they're going to talk you into the traditional IRA. And I'll just tell you, in retirement, Roth IRAs are probably the way to go if you've got assets that are producing income like real estate. So personal plans can be self-directed. Traditionals and Roths, you can also self-direct employer plans. If you're self-employed, you can basically, it's another item on the menu. A SEP IRA, a simple IRA, or even a solo 401k could be self-directed here at Directed IRA, but you have to be self-employed in order to have those plans. I'm not going to go too deep into those plans, but what I will tell you is you have larger contribution limits to those plans than your traditional and Roth IRA. I want to make a point here. When I'm talking about contributions, I'm talking about the money you take out of your pocket and add annually. When it comes to profit, profit's unlimited. So a lot of people get confused about, well, I thought I can only put in $6,500 a year into my IRA. How can I make $100,000? $100,000, if you're selling real estate in an IRA, that's profit. That's not contribution. Contribution is what you put in out of your pocket each year. But the contributions are larger if you want to stuff more money in and you have some self-employment income into a SEP, a simple, or to a solo 401k. A lot of our clients who are self-employed also have both plans because you can contribute and self-direct a Roth IRA at the same time, have a SEP or a solo 401k. It just gives you more buckets to put money in that can be invested completely tax-free that Uncle Sam can't touch. So I will just tell you this and not giving you investment advice. My two favorite accounts, if you're going to invest in things that grow, will be your Roth IRA and also look at our solo 401k Roth. We have a Roth 401k that can also be self-directed. You can put a ton of money in there. You could be invested into real estate, but there are some cool bells and whistles to a solo 401k that's different than an IRA. But I think you should have both because both grow tax-free and create tax-free income for future generations. You can also self-direct HSAs and ESAs, which were not even retirement accounts. These are today accounts that you can use profit today. You don't have to wait to retirement. I personally have a self-directed HSA, and I invest that all the time with my Roth IRA. I invest it into notes secured by real estate. Just to give you an idea of what I do with my retirement account, I leverage other people that are buying and selling real estate. I've been in real estate, but at the end of the day, I don't like dealing with toilets and tenants. I think there's much more people that are better equipped to do that than I. But I'm just the finance piece with my IRA. And there's a lot of different ways you can be passive with your retirement account. I do it through notes secured by real estate. When I loan money to a real estate investor, usually what I'm doing is on the promissory note, it reads my Roth IRA and my HSA as the lender. Okay. It goes through directed IRA. I don't even touch the money. Basically, we just draft a promissory note that show my IRAs as the lender. Okay. We agree to terms, and that money goes out to a person fixing and flipping a property. Now we close at a title company, so my IRAs are secured with a mortgage or a deed of trust. But basically what I do is I sit back and just collect. I don't collect. Directed IRA collects interest income from that borrower's payments that gets split between my Roth IRA and my HSA because I've got both of them listed as the lender on that note. Here's the difference between how I can use that money. The interest income that's going to my Roth IRA, I want to save that and I don't want to take it out until 59 and a half because I'm penalized. But the interest income coming to my HSA, I can take that out today, tax-free and penalty-free, to use it for any qualified health expense. Qualified health expenses are things like, when's the last time you went to CVS or Walgreens? Everything in that store is a qualified health expense. Things like prescriptions, eyeglasses, dental visits, holistic medicines, acupuncture, co-pays. So you can self-direct retirement accounts, but you can also self-direct a health savings account and use the tax-free dollars to pay for you and your family's health expenses, the things that your insurance plan doesn't cover. The other cool thing with a self-directed HSA is when you put money into it, you get a tax deduction at the same time. So it's tax deductible going in, tax-free as you invest it, and then tax-free when you take money out. There's no other account on this whole page that has three tax features like that. So tax-free going in, tax-free as you invest it, tax-free when it comes out. We can also self-direct what's called Coverdell Education Savings Accounts. These are really nice accounts if you've got kids under the age of 18 who've got health education expenses, things like tuition, room and board, books, if you're buying your kids computers or iPads, even your home internet bill is an education expense in the eyes of the IRS if your kids are doing homework on the internet. Think how most Americans are paying for those expenses when it comes to tuition and books and internet. They're not paying it out of a tax-free education savings account. They're paying it out of their back pocket. Well, the problem with paying those expenses out of your back pocket is you've got to go make money, then pay taxes, and then whatever's left over, pay for tuition and those types of things. If we can switch our mindset as investors and think, well, I've got this real estate investment that I'm interested in. I'm going to invest my retirement in there so I can create some tax-free income for retirement. But I also have some today expenses. So education savings accounts can also be self-directed. And the cool thing, when the education savings account is the investor and it has income coming in, you could take the distributions out of the ESA to pay for all those things that I mentioned, and it's tax-free. So just think about that. Instead of working a certain amount of hours to make $10,000 or be left with $10,000, I got to make $18,000 if I'm a taxpayer. But if I go out and make an investment that makes $18,000 in the ESA, I get to use $18,000, not 10. Again, it's just the mindset shift on how you can use accounts, not only to retire tax-free, but pay for current expenses. And you find that you can consume more goods with the same amount of profit because Uncle Sam's not in the equation. So you can self-direct all these plans. And I think that you want to look at all these plans if you've got health expenses and kids under the age of 18. So um, I talked a little bit about this, so I'll kind of wanted to share this. Again, how this process works is if you want to buy real estate or other alternative investments, you got to just work through a company like us. But at the end of the day, remember, it's your retirement account that owns it. You still get to take distributions out of those accounts, but think how you want to take the distributions. You want to take them taxable in retirement, or do you want to take them tax-free out of a Roth IRA? I think the Roth IRA is the way to go. Okay. You can also partner accounts together. This is where I see most clients really maximize the accounts that I just kind of mentioned is by having all the accounts that give them tax-free income, right? Roth IRAs, Roth 401k, HSA, and Coverdell, all of those accounts can be distributed, if as long as it's qualified, completely tax-free. Partnering accounts is very common when we have clients that have needs for all those expenses. And how it really works is you just want to think about each plan as its own buyer, right? They all have to stay in their own separate buckets, but each bucket can invest in the same asset. Okay. I mentioned I invest in notes. Okay. I partner my Roth IRA and my HSA on a note investment. If you want to invest multiple plans into real estate, you can do that as well. We actually set up a lot of clients who like to multiple plans together. What we actually have is upstairs, we've got a law office called KKOS Lawyers. The KKOS Lawyers is phenomenal because they all day they work on asset protection for clients, setting up entities for small business owners. But what they also do for our clients is they set up what's called a checkbook IRA LLC. I'm going to just touch on this, but you can guys ask me more questions later. But how a checkbook IRA LLC works, especially if you're going to work in real estate, it basically allows us to put all your plan's money into one central location where you've got a checking account. We set up an LLC for you in whatever state that you're operating in. You have a consultation with an attorney, but we have an LLC, and the owner of the LLC is not you. The owner of the LLC is your Roth, your solo 401k, your HSAs, and maybe all your Coverdell education savings accounts. They all own a piece of that LLC. What that enables us to do is put all of your funds into one bank account, the LLC's bank account. You, as the manager, can write one check for whatever investment that you want to invest in. Okay. Now, I got to remind people you can't take money out to yourself personally. That's one of the big no-nos with the checkbook IRA LLC. But what it does is it does gives you an LLC where all of your plans are in one central location. And when you make investments, let's say an investor pays back that investment, that just goes back to the LLC bank account. Okay, so you got to deal with us less, which is sometimes nice. And then at the end of the day, if you need to take a distribution to pay for any expenses or retire, you just send that money back to us first. Okay, so the checkbook LLC gives you some ease of use. I'll talk a little bit about it at the end, but it also allows you to put multiple buckets of money into one location. I'll talk a little bit about the process here in a sec, so I don't want to skip too far ahead. So what are the attractive things with real estate? I kind of already mentioned this. Real estate's tangible, which I like. It's a good way for people to really diversify their retirement portfolio. You do not have to be a real estate expert to invest in real estate. I would probably say 20% of our clients are considered experts in real estate or alternative assets. Most of our clients just like to invest passively because they're looking to diversify out of the stock market. Most of our clients have an IRA still with some money in the stock in stocks, but they have a directed IRA as well because they want better diversification than just multiple mutual funds. So they invest in real estate through self-directed IRAs. The tax savings is big. If you understand how IRAs grow and understand how distributions work, and you apply real estate or alternative assets with income streams to it, that's really how the rich have been doing it for many, many years. But ultimately, what a self-directed IRA allows you to do is just invest in what you want to invest in without being sold an investment. And a lot of times it allows you to invest in things that you're knowledgeable about. Okay. And most people I find understand how a three bedroom, two bath house works versus how why a stock goes up and down in value. So at the end of the day, I think people just ultimately understand real estate better. They feel comfortable with real estate. They drive past real estate every single day, and your IRAs or your 401ks can be invested into that same real estate. And we'll talk a little about that through the case studies. I do want to touch on just some brief rules real quick so you understand there are some no-nos with self-directed IRAs or IRAs in general. But you don't really have to talk about this when you're buying investments from Wall Street. But you do have to talk about this when you're investing in things like real estate or we call private investments. So there's three restrictions that you want to cover when you talk about IRAs and their investments. I already covered the first one. The investment restrictions are the things the IRS says we're not allowed to hold. That's just life insurance contracts and collectibles. The bigger thing to talk about with self-directed IRAs is the people restrictions to your IRA. Now, these are the same rules with Fidelity. They just don't have to talk about it. We have to talk about it because we have to make sure that when you're self-directing your IRA, you're not transacting with the people the IRS doesn't want you to transact with, because that's their big key item. They don't care about what you invest in. They care about who your IRA or retirement account transacts with. You're the main disqualified person to your IRA. And why is that? Well, you're the fiduciary to your IRA. As a fiduciary, what that means is you have a responsibility to make your IRA grow. And by making it grow, the IRS wants you to put money in and then invest it. Have investments in your retirement account. What they don't want you to do is tell your IRA to invest back to you. That's just a mass distribution. They don't want you selling your stuff to your own IRA because it's a conflict of interest. As a fiduciary, you have to act in the best interest of the IRA, not the best interest of yourself. You get your benefit from the distributions, but your IRA has to get benefit from making investments, but you're allowed to pick the investments. So what that means is you just can't be on the other end of the transaction when your IRA buys something. Okay, your IRA can't sell things to you. You can't buy things from your IRA. You have to buy investments from non-disqualified people. There's other people that are disqualified as well, but what they're not allowed to do, and I'll show you the list here in a second. You can't buy, sell, trade, loan, or extend services to your IRA. It's pretty basic. Buying, selling, loaning, that's pretty self-explanatory. Extending services is a little different. It doesn't get people into much trouble, but this is where most investors, again, realize they want to be passive with their retirement account. Because when it comes to your retirement assets, the IRS just wants you to be hands off. They don't want you to be involved in the investment. And what I mean by involved in the investment, they don't want you swinging hammers. When you're a fiduciary to your IRA, you're allowed to be the good fiduciary, pick investments, pick contractors that work on that investments, pick renters that might live in those investments, but they don't want you actually involved with swinging the hammer or what I'll call sweat equity. It's really brain versus brawn. Okay. If you have a piece of real estate owned in your IRA, you cannot be the contractor. Okay. You can't go in there and swing the hammer and build a new garage for your IRA's investment. You got to find other individuals or professionals that do that. And that's a little bit of a weird concept, but you just got to be hands off when it comes to your IRA's investments. And this is why people tend to be more passive. When you talk about the disqualified people as well, there's other people that also cannot swing the hammer, okay, or transact with the IRA. The other people included are your spouse, your parents, your grandparents, your kids and your grandkids, and their spouses. Now, why did they disqualify just those people and not brothers, sisters, aunts, uncles, and family to the side? Well, if you look at the line of inheritance, when we have a retirement account and we die, that usually goes to our wife or our kids, right? Community property states are always going to leave stuff to your spouse, right? That's how usually most people pass on their wealth is they leave it to the spouse and then they leave it to the kids. So remember, as I mentioned before, when you die, your IRA doesn't just disappear. It turns into an inherited IRA that's most likely passed to those same individuals. So they're going to end up with your IRA when you die. So they are also considered fiduciaries to your plan. So if you've got an IRA, you cannot invest your IRA into your son's real estate deal. You could invest it into your brother's real estate deal or your sister's real estate deal or your uncle. So you can invest with certain family. They just don't want you investing with the family that are going to inherit the IRA at the end of the day. So that's really the main thing the IRS wants us to stay away from is just our IRAs and our 401ks transacting with the people that are also taking the distributions. Okay. That's when you get your benefit is by taking the distributions from the plan's income. And again, if you play by those rules, you're perfectly good. And we try to do our best by giving people a lot of education on that through the door. But ultimately, if you're just investing passively into other people's deals that aren't family, you're good to go. And that's how most people use their retirement accounts. So let's look at a real deal. So this is again, I'm going to start real brief with just real estate because I think it's easier to get the concept across. Even if you decide to be passive, I'm going to show you an active one here. So I have a client, Dan and Denise. Okay, they found a property that they wanted to flip in their hometown. Okay, this was the deal that they had passed by. They drove by. They saw this kind of vacant for a long period of time, and they wanted to be a little more active with their retirement account. So what they did is they both had old 401ks at their employers, and those had been rolled into IRAs. Now, when you have an IRA, it's very easy to move that money to a self-directed IRA to invest in things like real estate. If you have a 401k or employer sponsored plan, it might be a little tough if you're still working at the employer, but most people nowadays have old employer plans that are all already rolled into IRAs. Very easy to use those and move those over. So they both moved their Fidelity IRAs over to a directed trust company, directed IRA, set up an account, had us fill out a transfer form. Fidelity wires that money right over to us. Time frame on that, usually 3 to 5 business days. You can get an account set up online in 5 minutes. You talk to one of our representatives, they give you a transfer form to fill out. We send the transfer form to Fidelity on however much money you want to transfer, and that moves over by a wire from Fidelity. Usually takes 5 to 7 business days. What I will tell you is this is not a taxable transaction. Okay, a lot of people say, "Well, I'm not going to pay taxes on that." No, because we're not doing a distribution out of your IRA. We're just doing it as an IRA to IRA transfer. It's just moving from one IRA to another IRA. The money never touches your hand. So it's not a taxable event. Transfers aren't even reported to the IRS. The IRS doesn't even care about them. They're like, transfer as many times as you want to as many places as you want. We don't care because it's not a taxable distribution. So many of our clients, what they do is they move money back and forth between their two plans, right? They move money over to their directed IRA when they buy real estate. And if they get cashed out on that real estate and they don't have another investment, they just move it back to Fidelity. So we constantly have money going back and forth between us and companies like Fidelity and Charles Schwab. Now, once you get the account open and funded, this is where the self-directed piece comes in, is that when you are self-directing your IRA, you have to tell us what you want us to invest in. We don't have property to sell you or houses to sell you. You got to go out there and either find it yourself, which there's some challenges there, or you leverage somebody else to help it find it for you. But at the end of the day, what we're going to do as directed IRA, your custodian, we're going to take your direction to buy this asset. Now, how do you tell us to do that? We have an easy form that you fill out. It's called our direction of investment form. You just fill out what you're buying. Okay, tell us where the money needs to go. Tell us how much money you want to go there. And you turn that form in, that direction of investment form, in with a copy of the agreement. Now, here's where it can get a little hairy if you're buying real estate. You got to remember when your IRA is going to be the buyer, your IRA has to be shown reflected on the purchase contract. You're still doing all the same legwork as if you were buying the house yourself. The only thing you're not the buyer. So on the purchase agreement, what you're going to write is the vesting that we give you for your IRA. And just to give you an example, that would read something like directed IRA or directed trust company, FBO, your name and your IRA what type of IRA you're using. It's really that simple. So I just want to make sure that we don't overcomplicate things. Is you're still doing the legwork to find the investment, but your IRA is going to be the buyer. Okay. So what Dan and Denise did is they went out, they found the seller, they negotiated some terms, found out it was a property that was inherited. So they basically lived out of state. They really didn't do much with the property. So they bought the property at a discount. They got a pretty good deal on it. They bought it for $270,000 and they used their IRAs to be the buyer. Okay. So what they did on the purchase contract is they wrote two buyers down. Directed Trust Company FBO Dan Jackson's IRA and Directed Trust Company FBO Denise Jackson's IRA. We sign the purchase contract as the buyer. They turn in the direction investment form, give us the contract, we sign it, send it back to the seller's agent. Okay. So they're using us to send money and sign contracts, but they're kind of quarterbacking the entire deal. Okay. The contract tells us that we need to send $5,000 for earnest money. We're not handing $5,000 to Dan and Denise because that's a distribution. We're just sending $5,000 directly from their IRA to the title company. That's just an investment expense. When we get to the closing and we get to the title company, we sign the closing documents after the closing. The client has reviewed them and approves them. So we sign the closing documents as the buyer, and then we send the funds to the title company, the remaining funds to buy the property. If you think about it, Fidelity does the same exact thing, but they just do it with stocks. When you tell Fidelity to buy a stock, what they do is they exchange your asset of cash for an asset of a stock. You just don't see it because they just hold the stock certificate at Fidelity. But you're pushing a button telling them to buy. They hold a stock certificate. What we do is the same thing, just replace the word stock and put real estate. We exchange assets of cash for assets of real estate. We need the contract and the direction investment form to buy it, but all we're doing is exchanging an asset of cash for an asset of real estate. A lot of advisors are confused by this because you tell them, I'm going to go buy real estate with my IRA, and they go, wait, you're going to pay a bunch of taxes on that. You don't want to do that. What they envision people doing when they say that is they're taking money out of their IRA to go buy real estate. If you took it out of the IRA as a distribution, you would pay taxes. But we're not taking it out of the IRA. We're making an investment in the IRA. And that's why you have to use a company like us to perform those transactions so it's not taxed. So on the contract, they made it real easy. They said, I want my Dan Jackson's IRA is going to put 50% of the investment up, and Denise Jackson is going to put 50% of her IRA. Now, they use two different IRAs. Dan had a traditional IRA. Denise had a Roth IRA. They can both be invested, and those were the buyers on the contract. Any expenses going forward or any repairs have to be paid out of the IRA as well. So that's something that we help you do at Directed IRA. So they had a rehabber that did the rehab. We paid the contractor right out of the IRAs, and then all the income once we closed on the property, all the rental income comes back to their IRAs, and none of it's taxed. They can reinvest it, they can move it back to Fidelity, or they can leave it in there to pay for anticipated repairs. But all that money comes back to the IRAs at the end of the day. So when they sell the property, all the proceeds come back to the IRA as well. And we just repeat the process. This time, the seller on the contract is their IRAs. We still sign the contract, but all the income comes back to their IRA. So here's just a look at their deal, the net profit on their deal. They invested $270,000, half from Denise's Roth and half from Dan's IRA. They paid out to the contractors about $25,000 for expenses. They sold the property for $405,000. The net proceeds from the sale were about $87,000. So that gave Dan's traditional IRA a tax deferred gain of about 20, almost 30%, which is pretty darn good. And then Denise's Roth IRA made a tax-free gain of the same amount. Okay, but one's tax deferred and one's tax free. I think we got the point on that. So Dan and Denise's IRAs paid no taxes on the gains. They can reinvest all of that money, so their money grows much faster. Okay, this is different than a 1031 exchange. A lot of real estate investors will say, "Well, can't you just do that with a 1031 exchange?" 1031 exchanges are not like IRAs. IRAs can be invested into unlike property. 1031 exchanges, you can only invest in certain things. So it's a lot different than a 1031 exchange, especially when you look at the Roth IRA. It's tax-free, not tax-deferred. But when it comes to take distributions, that's when Dan and Denise will feel the effects a little different because Dan will be taxed on his distributions, Denise won't. So again, if you're making 30% return, I would say pay the taxes before you make the return, and that's where you get to the Roth IRA component. So Key points to remember: Dan and Denise are in full control from beginning to end. They just use Directed Trust Company as their third-party custodian to make the investment and make sure it's IRS compliant. No money was given to Dan and Denise as a distribution. And they're not required to set up the LLC that I mentioned. They did this investment outside of an LLC. But you could use the LLC if you're investing into with multiple accounts, more than maybe just two, or you're investing into things that you want a little bit more control over the money with your own checkbook. So once you set up that, I mean, it's really, you can write the checks on the investment. So if they did use the checkbook IRA LLC, the difference here is the LLC would be the buyer, not their IRAs. Okay, so it's a little bit different. You would just make the offer in the name of the LLC, and all the money comes back to the LLC bank account. So you can do either, but you don't have to do one or the other. A lot of people say, well, what if I don't have hundreds of thousands of dollars in an IRA? Can I still invest in real estate? The answer is yes. There's a whole lot of ways that you can invest in real estate, both actively and passively. Because your IRA, your self-directed IRA, you can use leverage. And what I mean by leverage is when you start picking your own investment, what you really are allowed to do first is leverage your own experience or your own comfort level. Okay. I want to invest in real estate because I'm more comfortable with real estate and I'm not comfortable with stock market. That's leverage because now you're leveraging your own decisions, but you can also leverage the experience of others. And listening to everyone on the webinar here is there's a lot of experience here outside of me on real estate. You can leverage other people's experience to help your IRA grow. I do that with the borrowers that I loan money to out of my IRA. My IRA does not own real estate. My IRA owns a note secured by real estate. As a bank, I use my IRA like a bank. Most of our clients want to be passive with their retirement accounts, not active. So people will invest in notes to individual investors, but even more common than that is people like to invest in bigger investments like apartments, syndications, commercial property, because I just showed you a single family property just to give you some foundation. You can invest in things all the way to skyscrapers if you want, but usually that's leveraging somebody else that's already finding the property, leveraging somebody else's talent that is buying multifamily property or commercial property. There's a whole game to that investments. And like I've mentioned before, 95% of millionaires are made in real estate. Your IRA can be an investor with those people as long as you can network with those people and leverage their experience. So it's out there, and more people are investing in self-directed IRAs because they can now find people that used to in the past you had to know these people and you didn't have the internet to find them. So there's a lot of investment opportunity out there in real estate. A lot of times it's done through investing in other people's deals. So how does this actually work? Well, it's really easy. And I know I'm starting real brief with you guys, and I'll take questions here in a second. But how do you start with self-directed IRAs first? If you've got an IRA or an old 401k, you just need to go online, fill out an application. It takes you literally 10 minutes, 5-10 minutes. You could do it on your phone. We'll have the account open to you by the next day. You'll get a welcome email. The welcome email will have your vesting information. Basically, that's the name of your IRA. So if you actually go out there and you've got a deal ready, you want to use that name on the agreements. But you first need to fund it. So you got to fund it either with an IRA transfer, and we'll walk you through that, or you fund it with a rollover from an old employer plan. We can walk you through that too. That involves a little bit more work on the old 401k provider. You have to communicate with them that you want to move your 401k or old 401k to an IRA. So they've got some specific documents you fill out with them. Those take a little bit longer, just to let you know if if your retirement is still in a 401k, they have to distribute the money out of the 401k first and send a check to us. It's the same thing. You're moving it from a retirement account to another retirement account. But since they're not like accounts, and since fundamentally what you're doing is you're leaving the 401k as a participant, you can't transfer it. You have to do what's called a rollover. Rollovers involve a distribution. Okay, so you'll get a 1099 from your 401k provider, but don't let it freak you out, because when you move that money over to Directed IRA or any other IRA custodian for that matter, what we do is we send an offsetting form to the IRS saying you didn't take a distribution, you moved it here. Okay, so that form is called a 5498 if you want to nerd out. The 1099 and the 5498 usually offset each other. Okay, you took it out, but you put it back in. So the IRS says no net effect. What you don't want to do is there's an indirect rollover options that some employers give you. Just be cautious of this. If your old employer says, do you want us to send the check to Directed IRA or do we want to send it to you? You probably don't want to say send it to you, because when they send it to you, payable, the person it's payable to is you. And when they do that, it's no longer in a retirement account. And they don't know if you're going to put it in a retirement account. So they usually withhold 20% and give it to the IRS as tax withholding. So you get, if you got $100,000, you get a check for 80. Okay. And you're like, where'd that other 20 go? Well, you told us to send the check to you. So what you want to make sure of is, if you're doing a rollover, tell them you want to do a direct rollover. The only thing that's different is payable line says directed IRA, directed trust company. When they know it's going from retirement account A to retirement account B, they don't withhold taxes unless you tell them to withhold taxes. So that 100 grand you got in that 401k is 100 grand in your IRA, and you can continue to reinvest that money now in a self-directed account. So that could take a little bit longer because, again, we got to wait on the 401k provider to mail a check and all that. But as long as you get the everything started early, you should be ready to self-direct once the account is open and funded. Now, how it works on these self-directed parties, you got to work through our transactions team. They walk you through the investment. I'm just going to forewarn you, it's going to be new territory the first time you do it, okay? Because it's different than buying a stock, but it's really easy once you do it once, okay? You know exactly what we need. We've got a great transaction team. If you go and read our reviews on Google, these are verified reviews. We don't pay for reviews like other companies. These are real clients leaving real reviews on Google. Go check it out. But we got a 4.9 rating, which is one of the highest. I think it's the second highest in the industry, but we've got the most 5-star reviews than any other company. And that's saying a lot, because a lot of us have been in the business for 10 years, but the company Directed IRA has only been open since 2018. Okay. We just opened our doors 2018. So to have 600 plus 5-star reviews and a 4.9 rating really says a lot about our transactions team. I can't take any credit for that. They are wonderful. So if you don't think you know how the account works, don't worry, because we'll help you along the way. I'll help you open it and fund it. But as far as like the investment team, they'll help you self-direct it and basically just tell you what things that you need. And it might be like, new territory for you, but once you do it once, it's like riding a bike. So just to give you some information about us, again, kind of mentioned, we've got a really high customer service rating. And I think that's important to you, especially if you're going to deal with a self-directed custodian. There's a lot of them out there, but you want to deal with the ones that have good customer service ratings, because you want this to be easy for you. You don't want to spend a whole lot of time on dealing with your custodian who's trying to invest in some alternative investment. You want to deal with less with us as possible, and we make the process really easy and painless. And we also were just named the only self-directed IRA company on the list, I believe, to the Inc. 5000 list for 2023 as fastest growing companies. So those are two big differentiators we have, is that we are good with our clients and we're a fast growing company, and we've even been recognized by Inc. 5000. But we also give you the true checkbook control option. Some companies do not allow that option. But some companies like us do allow that option. The reason why we allow that and other companies don't is we've got attorneys on staff, not on staff at Directed IRA, but on staff upstairs with KKOS lawyers, both owned by the same principals, Matt Sorensen and Mark Kohler. But those attorneys specifically work on LLCs and specifically checkbook IRA LLCs. So we understand the tax law, we know how to make it IRS compliant, and we also give you a good consultation on how you use it responsibly. Because one of the things with those checkbook IRA LLCs, I'll just warn people, is you've got to make sure that you understand the rules while you're using it. Because just by putting it into that LLC bank account doesn't mean you get to go wild, wild west and start paying for things that you shouldn't be paying for. You have to use it responsibly. And that's why a lot of companies don't like to set it up, but we give you a full consultation on what you should and shouldn't do. So we offer that if you want true checkbook control. And we also minimize the fees. There's some companies that charge you for every investment, and they charge you as the value goes up. We just charge you one flat fee. Doesn't matter how many investments you have in there. It's just one flat annual fee of $395 a year. Very, very easy. We make the process easily. If you want to book a call with me, you can just scan that QR code there and book a call directly with me if you want to talk more about your specific scenario. So here's my email. Sorry. Here's my email and my contact information. If you guys want to email me directly without booking a call, go ahead and just email me questions. And I guess I'll just take it open for questions now.
There's a few questions in the not the comments, in the chat. So one was, can we lend to our own LLC for real estate? So I'm guessing if they are an operator But
Great
even I
question.
guess on that question, could it be like direct to an LLC or even like say like a syndication that might have you on it too? Could you
So
go on both?
there, yeah, so you want to be cautious with that. So typically, if you're lending to an LLC, that LLC, it cannot be owned 50% or more by total disqualified people. So what I mean by that is the LLC owned by you, spouse, kids, parents, and does that total ownership exceed 50%? If the total ownership of disqualified people exceeds 50%, the entity is a disqualified person. So the IRS says if 50% or more is owned by disqualified people, the LLC is a disqualified person. Now, you still want to be cautious if you, so I have a lot of clients that will come back and go, all right, Nate, we set up an LLC and we're only 49% owners. So but you still want to be cautious because one of the things the IRS doesn't want you to do also is use your IRA to create yourself a personal benefit. So with lending to an LLC, even if you own it, it's probably still going to be disqualified because you are personally receiving a benefit through an LLC. The safest way with self-directed IRAs is just to not include yourself or your LLC on the other end of the transaction. Okay. If you want to invest, let's say, some personal money and your IRA money, the better way to do it, and the way that's not disqualified, is to work with our attorneys and set up the LLC, the IRA LLC, with you as another owner. You can do that. That's considered partnering because here's what's happening in that equation. When I'm setting up an LLC from the beginning and I want to use personal funds, let's just say 50-50, I can set up a multi-member LLC where my IRA is 50% owner and Nate Hare personally is 50% owner. Okay, we're both owners of that LLC. We both have it in one checking account. Okay, but I'm not on the other end of the transaction. I'm partnered with my IRA, and we're both going into the LLC together. Okay. From that point, I want to make sure that I keep everything pro rata. Okay, if I go in 50-50, all of the income that comes in, I only can take 50% of the income. Okay, so that's one of the main things. If it's 70-30, if I'm 30% personally, I can only take 30% of the income. So as long as you keep it pro rata and you go into the investment from the very beginning into the same LLC, that's the way to use personal funds and IRA funds. But if you've already got an LLC set up that the IRA doesn't own, you can't lend or invest right into it because you're on the other end of the transaction, if that makes sense.
Hey Nate, I have a question if you have a moment.
Yeah.
So I have a 457 and I'm currently employed through my employer, and I know that they have no ability to use that 457 monies in a self-directed IRA at this point. Do you know why that is? Why is it different from a regular traditional IRA where they have that restriction?
So as far as our end, we actually we get rollovers for 457 plans all the time. Maybe your employer is telling you is usually, are you still employed with the company? Or are you still employed with them? Is that right?
Correct.
That's
Correct.
usually why they're not letting you move that money. Most plans, even 401k plans, um, have restrictions on you taking the money out and moving it somewhere else while you're still employed. Now, 457 plans are a little bit more strict than 401ks. I will say if you've got a 401k, there are what's called in-service rollover options. This is for employees that have been tenured, they're fully vested, they're above a certain age. Again, these are all requirements that the 401k provider would have, but you can ask them if you've worked there for a long time, do you have in-service rollover options? I don't think the 457 plan comes with in-service rollover options. So I think that's the only thing that's preventing you is that you're still employed there. Once you retire or you leave, right? That money becomes accessible to you at that point for any plan. Once you have what's called separation of service, you can do what you want with your 457. You can roll it to an IRA, you can leave it there, or you can roll it into a self-directed IRA. So I think once you hit that point, that's where they'll allow you to move it. It's just the fact that you're still working there.
Awesome. Thanks for the clarification. I really appreciate it.
Yep. There are more questions?
There is another question. I think you kind of touched on this already, though. So Says, so we can use it for ourselves as long as IRA account is the buyer.
Correct. Yeah, and that confuses some people too. Is they think, well, I thought I can't buy my own investments in my IRA. You can't sell your own investments to your IRA, but your IRA can invest in all sorts of things as long as it's listed as the buyer. Okay, so you find the real estate. Again, you're not the one buying it. You're just finding it for your IRA to be the buyer, and we help you through that piece of the process. I also see one that I'll take. I see the person say, do they pay capital gains? No. This is one of the beautiful parts about IRAs is that IRAs, 401ks are tax exempt. They're exempt from paying capital gains tax. So I kind of mentioned if I buy and sell a piece of property and I make 100 grand, right? If I make that investment, I'm a taxpayer. Okay. I got to report that as income and I got to pay taxes on that. When it's in my IRA, there's no 1040 for the IRA. There's no tax form that you have to file every single year. It's just like when you buy stocks. When you buy and sell stocks, you don't have to pay taxes as you buy and sell stocks. It's the same thing. Just replace the word stock with real estate. You don't have to pay taxes on it. So as far as capital gains goes, it's non-existent, which is one of the beautiful parts. I want to mention this too. Some people also say, well, but Nate, I heard that you shouldn't invest in real estate in an IRA because you don't get depreciation. If you hear that, that's a mute point in my mind because real estate does give you a large opportunity to create depreciation if you have the right type of income to depreciate against. But it's almost a mute point because what do you use depreciation for? To offset taxes. What taxes are you trying to offset in your IRA? There are no taxes. So what are you going to depreciate against? If taxes are zero, there's no use for depreciation. But this is why you want to look at buying real estate outside of an IRA, because again, we're talking about income as a taxpayer. If I have income as a taxpayer and I'm trying to reduce my income, then yes, I can go out and buy real estate in my name or my LLC and use the depreciation to offset my income. But as far as my IRA goes, that just grows completely tax-free. I don't care about depreciation. I just care about making it grow. And I don't have to pay Uncle Sam a dime as I do that. So it's almost like a mute point. It's like, what do you use depreciation for if you're not taxed?
I have a question following that. So you know how you mentioned you can do like an entity that's half owned with your IRA, half owned with your personal. So say they want to benefit and take the depreciation, they could do that necessarily, put half from their IRA and then the other half, and then get like, say in a syndication point, you can get a negative K1, right, to offset
Yep.
their losses, but then make tax-free gains on their IRA part.
That's exactly right. So if you're 50-50 owner, you would get 50% of the depreciation. Your IRA could get 50% of depreciation if it needs to use it. So I didn't cover this, and I usually save this for future classes, but there are situations where your IRA could use depreciation only if it has to pay a tax. Now, if my IRA is going to invest 100% cash in a deal, right, and it owns it 100% cash, there's no depreciation I need in that scenario. But here's a scenario where, and it's still a good strategy, but let's say my IRA doesn't have enough money in it to buy the property I want to buy. Let's just say it's a $100,000 property. I only have $50,000 in my IRA. There's banks that will loan to IRAs. Okay. In the IRA, in the eyes of the IRS, if you use bank financing with your IRA's investment, okay, first you're allowed to buy an investment that is worth more than what you have in your IRA, but the financing piece of it, that is considered non-IRA money. So when you have income generated from that investment, the IRS says, wait a minute, 100% of that investment was not made by you. You borrowed 50% from a bank. So 50% of the profit goes to your IRA tax-free. The other 50% you got to share with Uncle Sam because it's non-IRA money. So people say, well, how's that work? It's a little bit different, but you can now use 50% of the depreciation for that side of it. So once it becomes a taxpayer, you can use depreciation expenses to offset that side of the income. And it's an important thing to consider because you don't want to get scared about the tax situation. You want to just look at it as a way to leverage your buying power. Putting your IRA in a taxable situation is not the end of the world because I've seen clients take their IRA and instead of buying one property, they buy three. Now they buy three because they have some bank financing coming in to help buy three. They do pay a little bit of tax on the debt piece, But at the end of the day, their equity is outpacing that. So it's really about cash on cash return. Yes, you can use bank financing to help your IRA grow. And a lot of times you see this actually through multifamily and syndications too, because correct me if I'm wrong, I don't know how you guys are setting it up, but most of the operators I know are using debt to help acquire the property. So it might be taxable to the IRA, but what a lot of the operators are doing is they're doing value add. They're driving the value of the property way up. So even if your IRA invests passively into, say, in syndication or a multifamily deal, you might have to be considerate of this tax, and it's called UBIT. Somebody just mentioned that. It's called unrelated business income tax. I always say it's something to be aware of, not something to be scared of. But I don't want to get too deep. I can go on and on about UBIT and how to minimize it and avoid it. But what I have seen, I'll just say this: what I have seen is when you have this UBIT tax, you just want to look at what's the cost of the tax and compare it to the cash on cash return. If my cash on cash return is higher after paying the tax, I'm going to pay the tax and get better cash on cash return instead of just investing all cash, eliminating the tax and making a lower return. So it's all about tax is not the scariest thing in the world. First, if you're paying a tax, it means you have income. So that's good. But you want to just factor in your cash on cash return. It's just a math problem. Paying tax is okay as long as your cash on cash return goes up. I got some other questions if you want to just read. It says, my husband has a traditional 401k from his employer. Can we roll that into a solo 401k or SDIRA? Are there fees for that as well? The first question, can you roll that into a 401k or solo 401k and SDIRA? Yes, you can do both. I would say the solo 401k, as long as you're self-employed, you can have a solo 401k. So you have to be self-employed and have some self-employment income to establish one. And you can move your 401k and roll that into a solo 401k. The beautiful part about that is the beautiful part about a solo 401k, if you're self-employed, is you can make the larger contributions. But it's great that you pointed that out, because that tax that I mentioned, that it's called UDFI, specifically, it's a form of UBIT. UDFI is a specific form of UBIT. UDFI stands for unrelated debt finance income tax, which is the debt that I'm talking about. You have to pay that tax in an IRA, but in a 401k, there's an exemption to paying the tax. So that's a beautiful part about the 401k. If you qualify for it, is you can buy debt leveraged investments and you don't even have to pay the tax, because there's a built-in exemption to the 401k and there's no built-in exemption to the IRA. It's still good. You still want to focus on the cash on cash return, but you get tax-free dollars in the 401k that you don't get in an IRA if you're buying debt leveraged investments.
Thank you, Nate.
Yeah. Someone said, you mentioned kids being able to inherit an IRA. Do you suggest opening accounts for children also for the children? Yes, I do. So with your IRA, you have to list beneficiaries. That's a little bit different when you're leaving your kids as beneficiaries to your account. That just means they're going to get it when you pass. Your kids can also have IRAs. Now, the only requirement to have an IRA for any child is just that they have earned income. So I have a 4-year-old. Well, I had a 4-year-old client. She's much older now. And it really wasn't the 4-year-old as the client. It was her grandmother as the client. And her grandmother was a real estate investor. She was buying property out in Houston, Texas. And what she did for her granddaughter was create her a Roth IRA. Now you would think, well, how's a 4-year-old have earned income? Grandma was a real estate investor and sold a book teaching her real estate strategies. Guess who was on the cover of that book? Her granddaughter, her 4-year-old granddaughter. She put her little business suit with glasses in front of an old IBM computer, holding a big wad of cash. She sold the book to real estate investors. That gave the 4-year-old a modeling income for that year of $5,000. She didn't give it to the 4-year-old. The 4-year-old didn't even know, but $5,000 was now income to the 4-year-old. So we established a Roth IRA for the 4-year-old, right? She made a contribution to the IRA. It was still from the income of the 4-year-old. But then what she did with the granddaughter's Roth IRA is granddaughter's Roth IRA and grandma's Roth IRA all went out and bought a piece of land outside of Houston. Okay. They owned that land. She pulled in some contractors that she knew and a construction company and all these things. and they started building on the land, and they sold off pieces of this land, and all the income came back, split with the other companies, but came back. The net income came back to grandma's Roth IRA and granddaughter's Roth IRA. By the time the granddaughter was 9, that $5,000 Roth IRA was $75,000. Think about being 9 years old with $75,000 in a tax-free Roth. Talk about a head start in life. Good God, if we all had $70,000 in a Roth by the time we were 9, think of where we would all be. This is not rocket science. This is just grandma understanding that she can invest a retirement account into real estate, and she can also have a retirement account for her granddaughter as long as she did something creative to give her granddaughter earned income. So we actually do have specific accounts here at Directed IRA. We call them for Roth for minors. You can set up Roth for your minors by basically, as long as they've got earned income, and most of our minors are not for. Most of them are in their teens, right? They have a summer job, or they're working for, that mom and dad's company. They put them on payroll, have them send some faxes and take out the garbage. We do a lot of education specifically on that. But as long as they have earned income, you can set up IRAs for them too. And you can partner those IRAs with your own IRA, dump them into, say, a checkbook IRA LLC, and all of them can take up proceeds from the investment income. But then you can also, the Coverdell Education Savings Account, again, is another component. Don't get Roth and ESA different. A child can have both. The Roth IRA is going to grow tax-free, and they don't want to use that till 59 and a half. But if you want to use some of the profit immediately to pay for education expenses for the child tax-free, you want to look about setting up the ESA too. So you have two accounts for the child, a Roth and an ESA. The ESA you use today, the Roth they use tomorrow, but they both grow tax-free. They say, so what are the maximum contributions for a Roth IRA? So if you're contributing for last year, 2023, you can still make contributions. If you haven't filed your taxes yet, you can make contributions to a Roth up to $6,500 for last year if you're under the age of 50, $7,500 if you're above the age of 50 for last year. Since we're in the new year, you can also contribute for this year too. You don't have to wait till the end of the year. I actually think it's better to make your contributions early. When you look at the numbers, people with the larger retirement accounts are the ones that contribute early in the year. I think what a lot of us have been conditioned on is we contribute at the very end of the deadline, before the deadline hits. Well, the problem is if I make my 2024 contribution next April, well, I'm losing 16 months that I could have invested that money. So why don't I just put it in right now? You can put it in as soon as we hit January 1st. So what we have a lot of investors do is making contributions for last year and this year. And this year they actually raised it whole $500. Woo! So we could put $500 extra dollars in a 401k. So you can put $7,000 in for this year if you're under 50, 8,000 if you're above the age of 50. But again, it's not about how much you contribute. It's good to max it out. It's all about what you do with it and grow it. Force the growth. Buy investments that grow, and you'll find that retirement is a little bit easier than most of us think about it when you start self-directing and taking control of the investments and having multiple income streams like real estate that are funding your retirement tax.
That's
I think, is
awesome.
that all
Thank
the
you, Nate.
questions? Yeah, no problem.
You went over your time, and you poured so much into us. We're so grateful and thankful for your time and answering all our questions.
I'm sorry, I
Yeah,
have one more question.
Sure,
Last
yeah.
question. For self-employed people, what do you suggest we open up? Solo 401ks or Roth IRAs? And at what point would you suggest opening up a retirement account?
That's a good question. Great question. I would open both. I'm just talking, I'm not giving investment advice, but I would open both. Why? Because I can open both. And when we go back to that page, or if you look back at that page, I can have a personal IRA and I can have an IRA as a self-employed person. It just gives me more buckets that I can max out and keep away from Uncle Sam. So the best way to do it is I want to have a Roth IRA, max out the contribution to that. But if I can qualify for the solo 401k, here's the cool thing with the solo 401k. Whereas the IRA, I can only put in $7,000. The 401k, I can put close to $70,000. So add another zero to that, right? So $70,000 goes a long way. You do have to meet some income requirements, but if you've got a lot of income, that's a 401k allows you to stash more money in every year that their IRA doesn't. They're both good, but I can do let's just say I make round numbers, 7 over here, 70 over here. I want to do 77. I don't want to just do 70. I want to do 77. Now the 401k, here's another cool thing is if you qualify for it, you can also have your spouse as a participant and you can put another $70,000 in for your spouse. So now we're talking $140,000 that can be put into a solo 401k. So it's a larger money dump. Again, you have the built-in exemption to the UDFI tax that I mentioned. So if you're going to buy investments that might be taxed, not the end of the world to use your Roth, but if you've got the opportunity to do a 401k, do it in the 401k instead.
Thank you so much. That was super helpful. Thank you so much, Nate. We really
Yeah,
appreciate
no problem.
So everyone, if you guys haven't already, there is in the chat links and you know, everything to get in touch with Nate. He's a wealth of knowledge. Definitely use him for any of your self-directed needs. But we will send a replay of this video so you'll have those resources, and we'll send his contact information to you guys on there as well.
Awesome. Well, thanks for having me, guys. I hope this was helpful. If you want more education, just go to our website, directedira.com. If you go to our Learn page, we've got a host of workshops, webinars, podcasts. So we do consistent education throughout the week. So if you're interested in tuning in, just go onto our website, sign up for our newsletter, or just register for one of my workshops. I have different workshops and we cover different categories. So if you're not quite ready to get started, you want to learn more, we've got opportunities for you to learn more.
That's awesome. Big mahalo to you, Nate. Thank you for coming on. Really appreciate you. And to everybody who tuned in for the webinar, thank you guys for being present and learning along with us.
Thank you so much, guys. Have a good rest of your day.
Take
You
care.
too. Bye.